Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we're going to be solving the very first OT case study from your FM section B. This is the name of the company is BMC company. Without any further ado, let's get started. So with the very first question, I'm able to find out that this is a section B question which has been tested from the business valuation area. So the first requirement wants me to calculate the equity value of BMC company using the average PE ratio to the nearest $1 million. So let's read the information. BMC company is a listed company which is seen as a potential target for acquisition by financial analysts. The value of the company has therefore been a matter of public debate in the recent weeks, and the following information is available. So you have for 4 years the profit before tax, after tax, and the dividends. Then you have the statement of financial position. The shares of BMC company have a nominal or a par value of 25 cents per share and a market value of $4.05 per share. The business sector of BMC company has an average PE ratio of 17 times, and current cost of equity is also given to you as 10%. Expected NRV of non-current assets and inventory are these and these respectively. In the event of a liquidation, only 80% of the trade receivables are expected to be collectible. So let us move to the solving of the very first question over here. We need to find out the equity value of BMC company using the average PE ratio. So PE ratio is given over here. PE ratio is given to us as 17 times. And the next thing that we need are the earnings. So for the sake of our calculation, we are going to take the most recent earnings, which over here you can see as 11.3. So my earnings are 11.3 and my PE ratio is right above. So the value of the company is nothing but 11.3 multiplied by 17. This gives you 192.1. Because you need to round it off to the nearest million, I'm only going to put 192. All right, moving ahead to the next one. Over here, you have to find out the value of the company using the NRV basis. So the information I remember was at the last. So this was question number 16. Let's move to question number 17 now. 17 wants you to find out the NRV basis. So first, you have to take the net realizable value of all of your assets and then you subtract all of the liabilities. So first, let's take the assets. With respect to the assets, the first thing that you see in the statement of financial position are your non-current assets, which are now realizable for only $92 million. Similarly, inventory is 3.8. And with regards to more assets, you are only left with trade receivables. 5.5 is what their book value looks like. And then only 80% of them are recoverable. So 80% multiplied by 5.5 will give you the NRV of your trade receivables. So total this up and you will get the total NRV of your assets. So these are the NRV of all of the assets that the business has. And then I need to subtract all of the liability portion from it. So ordinary reserves, ordinary shares and reserves, these are both part of equity. Bonds and current liabilities fall under my liabilities. So minus 30 minus 6.5 gives me 63.7 and I choose this option over here. Moving ahead to the next one, this is question number 18 now. So with regards to question number 18, you can see you have to find out the value of the company using dividend valuation model. So first you will, because you have the dividend information all given to you, you're first going to work out the growth rate and then you will use that growth rate to put the values in the formula and then ultimately find the value of the company. So for the dividend growth rate, you first take the latest dividend, divide that by the earliest dividend, raise it to the power of 1 by n minus 1. So the number of years you have the data is 4 years, minus 1 gives you 3. So this minus 1 gives you your growth rate. So this roughly is 5% of growth rate in your dividends. Now the formula which we have learned to calculate the value of the shares is basically nothing but your dividend 1, D1. So 6.5 over here is your dividend multiplied by 1 plus 5%. This over here is your numerator. And then you divide this whole thing by the cost of equity minus the growth rate. Cost of equity is 10%. 10% minus growth rate of 5% gives you 5% again. So you arrive at an answer of 136.5. Moving ahead, this is question number 19 now. Share prices takes, so basically you have to identify which of the following statements relating to capital market efficiency is or are correct. Share prices take several days to respond to new information if a capital market is strong form efficient. Absolutely incorrect. It does not take, any time in a strong form efficient market for the markets to react to any new information. Strong form markets at any given point of time are representing both published as well as unpublished information. Hence, the statement is absolutely incorrect. Moving to the second one, it tells you in a semi-strong form capital market, fundamental analysis cannot produce abnormal gains. So according to the theory that we have studied when it comes to these form of efficiency of markets, in a semi-strong form efficient market, fundamental analysis will not be able to give you abnormal gains. Only having insider information can give you abnormal gains. So over here, statement 2 is absolutely correct. We move, and this is the last question, question number 20 for this case study. Which of the following statements in relation to behavioral finance is or are correct? Behavioral finance supports the view that stock market bubbles result from rational investment decisions. This is absolutely incorrect. Stock market bubbles result from irrational investment decisions. So, one is incorrect. Noise traders make rational decisions on fundamental data. Absolutely not. They do not do any sort of fundamental analysis. They simply overreact to good and bad news without any rational analysis. So both statement 1 and 2 are incorrect over here. Hence, because it is asked which is correct, I mark neither 1 nor 2. With this question, we are done with the very first case study, which is BMC company. Now, in the next video, we are going to start with the next case study. I hope that this was useful, and I will see you in the next one.